Want to make money with affiliate marketing, but not sure where to start? A lot of people think it's just about spamming links everywhere, but that couldn't be further from the truth. Today, I am going to break down the real strategies that successful affiliate marketers use to build a sustainable income, and it all starts with one crucial element: trust. Think about it. Would you buy something a random stranger on the street told you to? Probably not. But if a friend you trust recommends a product they genuinely love and use every day, you're much more likely to consider it. That's the core principle of effective affiliate marketing. Your audience needs to see you as that trusted friend, not a pushy salesperson. So the first and most important rule is to only recommend products you genuinely use, believe in, and can stand behind. I can't stress this enough. If you haven't tried the product yourself, how can you honestly tell your audience it's worth their hard-earned money? Your credibility is your most valuable asset. Once you lose it, it's incredibly difficult to get back. When you know a product inside and out, you can provide so much more value than just a link. You can create detailed reviews, tutorials showing exactly how you use it, and case studies demonstrating the results you've achieved. You can answer specific questions from your audience with confidence and authority because you're re-speaking from personal experience. This is what sets you apart from the thousands of other people just dropping links and hoping for a click. For example, let's say you're a photographer and you love a particular editing software. Instead of just saying, buy this software, here's my link, you could create a whole series of videos. One video could be a deep dive into your favorite features. Another could be a tutorial showing your editing workflow from start to finish. You could even do a comparison video with other popular software, explaining why you ultimately chose this one. You're not just selling a product, you're providing a solution and sharing your expertise. The affiliate link becomes a natural, helpful extension of your content, not the entire point of it. This brings me to my second point. You need to own the relationship with your audience. What does that mean? It means you shouldn't build your entire business on a platform you don't control or rely solely on one affiliate program. Imagine you've built a huge following on a social media platform, and one day the algorithm changes, or worse, your account gets suspended. All that hard work could vanish overnight. Or what if the affiliate program you promote cuts its commission rates or shuts down completely? Your income stream could dry up instantly. To protect yourself, you need to build a direct line of communication with your audience. The best way to do this is by starting an email list. Encourage your viewers, readers, or listeners to sign up for your newsletter. You can offer them a freebie in exchange, like a checklist, an ebook, or an exclusive video. Once they're on your list, you have a direct way to reach them, regardless of what happens on social media or with any single affiliate program. Your email list is your own private community. It's where you can nurture that relationship, provide even more value, and build deeper trust. You can share personal stories, behind the scenes, content, and special offers. You're not just a faceless content creator anymore. You're a real person they know, like, and trust. This direct relationship is far more valuable than any single affiliate commission. It allows you to diversify your income streams over time. You can promote different products, create your own digital products, or offer services. Your audience isn't there for one specific affiliate link. They're there for you and the value you provide. Now, let's talk about something that's not just a good practice, but a legal requirement in many places: disclosing your affiliate links. This is non-negotiable. You must always be transparent with your audience when you're using an affiliate link. It's about honesty and respecting the trust they've placed in you. Think of it this way. If you hide the fact that you might earn a commission, what does that say about your recommendation? It makes it seem like you have something to hide, like your primary motivation is the money, not helping your audience. This can instantly damage your credibility. On the other hand, when you're upfront about it, most people will be perfectly fine with it. They understand that creating high-quality content takes time and effort, and using affiliate links is a way to support your work so you can keep creating more. A simple disclaimer like, just so you know, some of the links in this description are affiliate links, which means I may earn a small commission if you make a purchase at no extra cost to you. I only recommend products I use and love, is all it takes. Put this disclosure in a clear and conspicuous place. On YouTube, that means at the top of your video description. On a blog, it should be near the top of the post. Don't bury it in fine print at the bottom of the page. The goal is transparency, not just ticking a legal box. Being open about your affiliate relationships actually reinforces trust. It shows you're confident in your recommendations and have nothing to hide. It's a win-win. Your audience gets a great product recommendation from a trusted source, and you get to earn a commission for your work, allowing you to continue serving them. So, to recap the 3 pillars of successful and ethical affiliate marketing. First, build trust by only recommending products you genuinely use and believe in. Go deep, provide immense value, and share your personal experience. Second, own the relationship with your audience. Don't rely on third-party platforms. Build an email list to create a direct, lasting connection. This is your most valuable asset. And third, always disclose your affiliate links. Be transparent and honest. It's not just a rule. It's a fundamental part of maintaining the trust you've worked so hard to build. Affiliate marketing isn't a get-rich-quick scheme. It's a long-term business strategy that requires patience, consistency, and a genuine desire to help your audience. When you focus on serving first and selling second, you create a sustainable business that can support you for years to come. You're not just chasing commissions. You're building a brand and a community around your expertise and authenticity. Start small. Pick one product you're passionate about. Create one amazing piece of content that provides incredible value. Start building that email list one subscriber at a time. It might feel slow at first, but every video, every blog post, and every email is a brick you're laying for the foundation of your business. Focus on that trust, own that relationship, and always be transparent. That is the real secret to winning at affiliate marketing. Thanks so much for watching. If you found this helpful, give this video a thumbs up and consider subscribing for more tips on building a business online. Let me know in the comments which product you're passionate enough to promote. See you in the next one. Ever wondered if there is a middle ground between the safety of bonds and the growth potential of stocks? Well, there is, and it's called preferred stock. Today, we're diving deep into how you can make money with this unique investment vehicle. It's often overlooked, but for savvy investors, it can be a golden ticket to steady income and even some surprising growth. So grab a coffee, get comfortable, and let's unlock the secrets of preferred stock. First up, the main attraction, fixed dividend income. This is the number one reason people invest in preferred stocks. Think of it like a paycheck from your investment. Preferred stocks usually come with a fixed dividend rate. This rate is a percentage of the stock's par value, which is a face value assigned to the stock when it's issued. For example, if a preferred stock has a par value of $100 and a 6% dividend rate, you can expect to receive $6 per share every year, usually paid out quarterly. This predictability is a game changer for anyone looking for reliable cash flow. If you're a retiree or just someone who wants to supplement their income without the wild swings of the common stock market, preferred stocks are a fantastic tool. It's like setting your financial clock to a steady rhythm. You know what's coming and when, which makes planning your finances so much easier. But wait, it gets better. Let's talk about dividend priority. The preferred stock isn't just a fancy name. It means you're in a special class of shareholders. When it's time for the company to pay dividends, preferred shareholders get paid first. Before a single penny goes to the common stockholders, the company must fulfill its obligation to you. This is a huge safety net. Even in tougher times when a company might be struggling, they have to settle up with their preferred investors before rewarding their common shareholders. And what if the company hits a rough patch and has to suspend dividends for a while? This is where a feature called cumulative preferred stock comes into play. If your stock is cumulative, any missed dividend payments accumulate. They don't just disappear. The company owes you that money, and they have to pay all of those back due dividends, known as dividends in arrears, before they can resume paying any dividends to common stockholders. This feature adds another powerful layer of security to your income stream. It's like a promise from the company that you'll eventually get what you're owed. Now, you might be thinking, okay, steady income's great, but what about growth? I want my money to do more than just sit there. This is a common misconception about preferred stocks, that they're just boring income plays, while they are generally less volatile than common stocks. There's definitely potential for capital appreciation, meaning the price of your shares can go up. One of the biggest drivers of this is interest rate fluctuation. Preferred stocks have an inverse relationship with interest rates. Think about it this way. You buy a preferred stock that pays a generous 7% dividend. A year later, the central bank lowers interest rates, and new preferred stocks being issued are only offering 5%. Suddenly, your 7% stock looks incredibly attractive. Other investors will be willing to pay more for your shares to get that higher yield. As a result, the market price of your preferred stock goes up. So, by keeping an eye on the broader economic environment and interest rate trends, you can strategically buy and sell preferred stocks to lock in some nice capital gains. But the real secret weapon for growth in the preferred stock world is a feature called convertibility. Some preferred stocks are convertible, which means you have the option to exchange your preferred shares for a predetermined number of common shares of the same company. This is where you get the best of both worlds. You get the stable dividend income of a preferred stock, but you also have a ticket to the upside potential of the company's common stock. Imagine the company you've invested in releases a groundbreaking product and its common stock price skyrockets. With convertible preferred stock, you're not left on the sidelines. You can convert your shares and ride that wave of growth, potentially multiplying your initial investment. It has a powerful feature that gives you the defensive stability of a preferred stock with the offensive potential of a common stock. It's like having a safety net with a built-in trampoline. Let's also talk about what happens in a worst-case scenario. No one likes to think about it, but companies can go bankrupt. This is another area where being a preferred shareholder really matters. In the event of a company's liquidation, there's a pecking order for who gets paid from the remaining assets. At the top are the bondholders and other creditors. Right after them are the preferred stockholders. And at the very bottom of the list, the common stockholders. This priority in liquidation means you have a much better chance of getting some or all of your investment back compared to common shareholders who often walk away with nothing. It doesn't guarantee you'll get all your money back, of course, but it significantly reduces your risk. It's another layer of protection that makes preferred stocks a more conservative choice than their common counterparts. Finally, let's touch on a less common but very interesting feature, participating preferred stock. This is like getting a VIP pass to the company's success. With participating preferred stock, you receive your regular fixed dividend. But that's not all. If the company has a banner year and decides to pay out a large dividend to its common shareholders, you get to participate in that extra profit. The terms vary, but typically once common dividends reach a certain threshold. Participating preferred shareholders receive an additional dividend on top of their fixed one. This feature allows you to share in the company's prosperity beyond your guaranteed payment. It asks a way to enjoy the stability of a fixed income while still having a stake in the company's runaway success. It's not a feature you'll find on every preferred stock, but when you do, it adds a very appealing layer of potential return. So let's recap. How do you make money with preferred stocks? You build a predictable income stream through fixed dividends, which are paid out before common stock dividends. You can profit from capital appreciation when interest rates fall, making your higher yield shares more valuable. You can tap into explosive growth by using the convertible feature to switch to common stock when the time is right. You have a higher claim on assets in a liquidation, protecting your principal investment. And with some stocks, you can even participate in extra profits alongside common shareholders. Preferred stocks are a versatile and powerful tool for any investor's portfolio. They offer a unique blend of income, safety, and growth potential that's hard to find elsewhere. They might not have the headline-grabbing drama of high-flying tech stocks, but their steady, reliable performance can be the bedrock of a strong financial future. Of course, like any investment, it's crucial to do your own research. Look at the company's financial health. Understand the specific features of the preferred stock you're considering as cumulative, convertible, callable, and consider how it fits into your overall investment strategy. Thank you so much for joining me today to explore the world of preferred stocks. I hope this has demystified them for you and shown you the exciting possibilities they hold. If you found this video helpful, please give it a thumbs up, and don't forget to subscribe to the channel for more deep dives into smart investing strategies. Drop a comment below if you have any questions or if you're already investing in preferred stocks. I'd love to hear about your experience. See you in the next video. Hey everyone, and welcome back to the channel. Today, we're re-diving deep into a topic that many of you have asked about: how to actually make serious money with rental properties. It's the dream, right? Sitting back and watching that passive income roll in every month. But how do you go from dreaming about it to actually doing it? Well, it's not just about buying any old house and finding a tenant. There's a strategy to it, and that's exactly what we're going to break down today. So by the end of this video, you'll have a clear roadmap to start building your own rental empire. So grab a notebook and let's get started. First things first, you can't build a successful rental business on a shaky foundation. And that foundation is market research. This is single-handedly the most important step. You need to become an expert on the area where you plan to buy. Don't just look at property prices. You need to dig deeper. Look for areas with high rental demand. What does that mean? It means places where lots of people are looking to rent, which keeps vacancy rates low. Think about cities with growing job markets, universities, or major hospitals. These institutions bring a constant influx of people who need housing, from young professionals to students to medical staff. Also, look at the economic conditions of the area. Is the local economy diverse, or does it rely on a single industry? A diverse economy is more resilient. If one sector slows down, the whole town doesn't go bust, which protects your investment. Check out local government websites for economic development plans. Are new companies moving in? Are there infrastructure projects planned, like new transit lines or parks? These are all signs of a healthy, growing area, which is exactly where you want to own property. Don't just browse listings online. Get in your car and drive through these neighborhoods at different times of the day. Talk to local real estate agents, property managers, and even residents. Get a real feel for the community. Your research phase will determine 80% of your success. So don't rush it. All right, once you've pinpointed your target market, it's time to talk about buying smart. The old saying, you make your money when you buy, not when you sell, is absolutely true in real estate. Your goal should be to find properties that are priced below market value. This might sound impossible, but they are out there. You just have to know where to look. These could be properties that need a little bit of cosmetic work, what we call fixer-uppers. Maybe it is a house with an outdated kitchen or terrible curb appeal that is scaring away other buyers. These are golden opportunities because a little bit of sweat equity can create instant appreciation. Another strategy is to look for neighborhoods that are on the verge of growth. These are often areas right next to already popular, expensive neighborhoods. As prices rise in the hotspots, people start looking for more affordable options nearby, and that's when these next-door neighborhoods start to gentrify and appreciate. Look for signs like new coffee shops, boutiques, or renovated homes popping up. Getting in early before everyone else catches on is how you can buy a property that not only cash flows but also grows significantly in value over a few short years. Work with a great real estate agent who specializes in investment properties. They often have access to off-market deals and can help you identify these hidden gems. Now that you own the property, the work isn't over. In fact, it's just beginning. This is where you can really turbocharge your rental income. Let's talk about enhancing the property to increase its rental value. The goal here is to make your property more desirable than the competition, allowing you to charge a premium rent and attract high-quality tenants who will take care of the place. So, where should you invest your money for the best return? The kitchen and bathrooms are almost always the answer. You don't need to do a full gut renovation with high-end marble. But simple upgrades like new countertops, painting the cabinets, and adding modern hardware can completely transform the space for a relatively low cost. Another huge draw for tenants is energy efficiency. Installing new energy-efficient appliances like a refrigerator or a dishwasher can be a major selling point. Tenants know this will save them money on their utility bills every month. Similarly, adding things like a smart thermostat or LED lighting are small touches that show you're a modern, thoughtful landlord. And let's not forget the number one amenity that tenants consistently look for: in-unit laundry. If your property doesn't have a washer and dryer, finding a way to add a hookup is one of the single best investments you can make. It can be the deciding factor for a tenant choosing your unit over another. Beyond the standard renovations, think about how you can add extra value that other landlords might overlook. These little extras can make a big difference in your bottom line. For instance, does the property have an unused basement or a large garage? You could potentially turn this into a secure storage space and rent it out as an add-on service, either to your tenants or even to people in the neighborhood. That's an entirely new stream of income from the same property. Another powerful strategy, especially in areas with universities, hospitals, or major corporate headquarters, is to offer furnished units. Furnishing a property, particularly for short-term or mid-term rentals, can allow you to charge significantly more. Think about traveling nurses, corporate transferees, or visiting professors. They need a place to live for a few months, and do you and it want the hassle of buying and moving furniture? You can cater directly to this market. It requires a bit more management and an initial investment in furniture, but the return on investment can be fantastic. You can also offer premium packages like including utilities and high-speed internet in the rent for a flat fee. This simplifies life for the tenant and allows you to build in a profit margin on those services. It's all about finding ways to solve your tenants' problems and making their life easier, for which they are willing to pay a premium. Finally, let's expand our thinking beyond the traditional single-family home. Don't limit yourself to just one type of property. Different property types can offer unique advantages and help you diversify your portfolio. For example, multifamily properties, like duplexes or fourplexes, are a fantastic way to scale your rental income. You have multiple streams of income under one roof, which means your finances are much more stable. If one unit is vacant, you still have income from the others to cover your mortgage and expenses. It's a built-in safety net. Plus, you can often get better financing terms for multifamily properties compared to buying multiple single-family homes. Another strategy is the house hacking model, which is perfect for first-time investors. This is where you buy a multifamily property, live in one of the units yourself, and rent out the others. The rental income from your tenants can help pay for, or in some cases completely cover, your mortgage. You are essentially living for free while building equity in an appreciating asset. It's one of the most powerful ways to get started in real estate investing with minimal risk. Also, consider different rental models. We talked about short-term rentals, which can be very lucrative in tourist areas. But also think about student housing near a university, or even commercial properties like a small storefront with an apartment above it. Each property type has its own set of pros and cons. So do your research and find the strategy that best aligns with your financial goals and your risk tolerance. Diversifying your property types is like diversifying a stock portfolio. It helps protect you from market fluctuations and maximizes your potential for long-term growth. So to recap, making money with rental income is a very achievable goal, but it requires a strategic approach. It starts with meticulous market research to find a growing area with high demand. Then it's about buying strategically, looking for properties where you can add value. Once you own it, focus on smart enhancements and adding extra amenities to maximize your rental income and attract the best tenants. And finally, do you want to be afraid to think outside the box and explore different property types to scale your portfolio and protect your investment? It's a journey, not a get-rich-quick scheme, but with the right knowledge and a solid plan. You can build a reliable stream of passive income that can change your financial future. Thank you so much for watching today. I hope you found this breakdown helpful and feel more confident about starting your own real estate journey. If you got any value from this video, please give it a thumbs up and consider subscribing for more content on building wealth through real estate. And I'd love to hear from you in the comments below. What's the number one thing holding you back from buying your first rental property? Let's chat about it. Thanks again, and I'll see you in the next video.